Hello, everyone. Dave Menapace here with the Hassle-Free RE podcast. I'm a real estate agent with Realty Executives Boston West. I'm also a real estate investor, consultant, or just someone that'll talk about real estate all day. So with that, I am joined here with Kathy Cole from On2 Mortgage. Kathy has done several mortgages for my clients, and today we're going to be discussing the ins and outs of the mortgage business. So with that, and without further ado, I'm going to introduce Kathy Cole, and we'll take it from there. Kathy, the floor is yours.
Well, thank you, Dave, for that lovely introduction. I am a senior mortgage planner here at On2 Mortgage. I've been doing this for a little over 15 years. I originally started in the banking business. I was a finance manager for a period of time, and then got into the mortgage lending end of the equation, and am currently, as Dave just mentioned, at On2 Mortgage. And certainly have had an experience working with a good number of first-time home buyers, repeat home buyers, refinances, you name it, pretty much all of the various scenarios over the past 15 or so years.
Awesome. So one of the big reasons that I was so excited to have you on today, Kathy, is that, you know, there's a whole bunch of things, right, happening in the industry right now, from home buying to interest rates to, it's a very unique time. And it's not so unique that it hasn't ever happened before, though, right? Like, we've had different periods of time where interest rates drop, interest rates rise, new products are available, old products are taken away. So what I would love to do is really sort of cater the beginning segment of our show here to more of the first-time home buyer. And what I'd love for you to do is sort of talk through maybe kind of like what a conversation is like when somebody's looking to get pre-approved, the importance of it, and really what goes into a pre-approval, and then ultimately the actual approval once somebody has gotten a house under contract. So maybe we start there, and then I'm sure I'll have a million questions for you as we get going.
Sure. So, I mean, obviously, as a, any buyer, first time or repeat buyer, the pre-approval process is very critical, because no one is going to accept an offer on your home without an actual pre-approval, which makes sense, because it really would be a waste of everyone's time if you're making an offer on a home only to find out afterwards that you can't actually afford those payments. So being pre-approved is critical. Obviously, if you've been through this process before, you would know that. But as a first-time home buyer, that is even more crucial step, because for you, it's an opportunity to find out a lot more about what you're comfortable with for a monthly payment, how your credit score impacts that, and so forth. So there's really three key things that go into a pre-approval, which are, number one, your credit score. Extremely important. Credit will play into what you get for a rate. It will play into what we do have maximum qualifying debt ratios, but those are more flexible when you have a good credit score. So really, a credit score is key. It's really, really important. And the credit score you get, we all see them. They come up on different, whatever we have, credit cards we have, et cetera. That credit score is not the same credit score that we're going to see. Lending scores are what we call triple score bank scores, which are always going to be a little bit different. Typically, they're a little bit lower. Sometimes they're higher, but it's a great, even though you're getting pre-approved, obviously, to get the mortgage, it's a good thing to do this early enough in the process, not the week before you plan to go out and look at homes, at least a few months ahead, at least, because if anything comes up on your credit report, either A, your score is a little lower than you'd like it to be, it takes a while to build that score back up. It's not an overnight process.
Right.
Or there are things that do get reported erroneously. And those can be removed. But again, it's not an overnight process. So that's why I always recommend, if you're a first time home buyer, that you get pre-approved, like I said, at least a few months beforehand. The earlier, the better, because that way you also can start thinking about really what your comfortable payment is going to be. Because as part of the pre-approval process, there's really three things we're going to do. We're going to run your credit report so that we can see what your credit risk score is, as well as your minimum required monthly payments. Because there is a debt ratio. Obviously, we don't want you spending 100% of what you bring in on your housing. You need to
How
eat.
come?
Um, and hopefully you get to go to the movies once in a while and out to dinner. So, so we're going to look at, those liabilities, what those are, your minimum payments. That would be for anything from your car loan to your student debt, to your revolving, what those minimum monthly payments are. Any installment loans that have less than 10 months remaining, we're not going to include. So we're going to look at that, and then we're going to look at your income. If your W-2 income, with a fixed monthly salary, that's going to be straightforward. If you make, $5,000 a month and you make the same amount every month, we're going to look at your housing payment plus your other liabilities, divide that into your gross monthly income, not what you actually take home, but your gross,
Okay.
and see where that falls. The maximum, no matter what product you're looking at, is going to be 50%. So if your gross monthly income is $5,000, your monthly payments, including everything, cannot exceed $2,500. If your gross monthly income, not payment, is 10,000, then it can be 5,000. And we'll obviously, if there's multiple borrowers on the application, your liabilities as well as your income will obviously be added together to come up with those debt ratios. And then the other third component that goes into your pre-approval will be the funds you have available for your down payment. If you can put 20% down, that's great, because you'll avoid having a monthly PMI payment. That's private mortgage insurance. Although, don't let that scare you away. I mean, PMI is not a huge payment, but you will have to pay it if you're not putting 20% down. The PMI in general, multiple factors go into how much that is: your credit score, how much you're putting down. For example, if you're putting 5% down, your PMI payment percentage will be higher than if you're putting 10 or 15% down. It is tiered.
Sure.
5%, 10%, 15%. But often those payments might be $80 a month. It might be $130, unless you're looking at a really large loan amount and you're putting the least amount down. Now, if you're a first-time home buyer, you can put 3% down with a conventional mortgage. FHA is another option. If you have a lower credit score, that's often a great option, is an FHA loan. And that's also an option if you are not a first-time home buyer and you only have 3.5% down. So those are a couple of different options there, but these are what we look at. So once, the importance of the pre-approval is that we do those three things. We look at your credit liabilities, your income, the funds you have, and that way we can look at what your maximum is that you qualify for. And more importantly, actually, what are you comfortable paying each month? So if you say to me, I don't want to pay more than $2,500 a month for my whole mortgage payment, the principal and interest, taxes and insurance, then we'll back into that number. So
Right.
it's, there's a maximum and then there's a comfort level. We all have that comfort level of where we're comfortable, I guess is the best way to put it.
So I love that. And let me unpack this a little bit, because I think that a lot of people that are buying right now weren't, even if they're going through the pre-approval process or they are pre-approved, if they're a first-time home buyer, they weren't experiencing other back in like 2007, 2008, and other times prior to that. So when we talk about debt to income ratios, right, like that is obviously a super important number. The government and lenders are making sure that we're not borrowing so much that we can't fulfill our obligation to the bank on the house. what would be really interesting is if you have this information, great. If not, totally no problem.
Oh,
I
Dave,
don't
I
want
don't
to
know
ever
what you're
put you on
about
the
to,
spot.
what are you about to ask?
What is the difference between now debt to income ratios and sort of these three things that, lenders are checking, what you're checking from say 2007, 2008, where things were a little bit looser in terms of lending, or at least that's the perception. But it would be, I don't know if you were in the business at that point in
I
time.
was,
Yeah,
I
look at
was.
that. So
Look at
how have
that.
those
Um,
guidelines and limits changed at all, if any?
Well, it's interesting because I mean, if you go, obviously, I can't remember how long the period was where guidelines kind of became too loose, shall we
Fast and
say?
loose, yeah.
Yeah, fast and loose, because, traditionally also too, debt ratios used to be even lower. I mean, when I first did lending, because I kind of was in lending, did the finance for a while, and back in lending, I can tell you when I very first did this, your total debt ratios at that point in time were much lower. You could never go to 50%.
Wow.
So they actually were lower originally.
Yeah,
They were more in the 30 something range,
yeah,
not 50. So that has expanded. But then there was, to your point, in 2007, 2008, I think was roughly when it ended. There was a period there where as long as you had excellent credit, um, I had people approve sometimes with debt ratio. Now, typically, this is more self-employed borrowers that may not show as much income on their tax
right,
returns. But I had people approve with a debt ratio of 60,
right,
65%, which does sound kind of insane. But as long as it went through the automated underwriting, which is what we do once we have all this
right,
information I mentioned, it gets put through an automated underwriting system. And as long as Fannie or Freddie, they're the two big lenders, um, as long as they approved it, but if you
right,
had, they would look, in some ways it was good because they looked at if you had excellent credit, if somebody's always paid their bills, and you have a good stable job history, you're probably, and it also took into account down payment. Don't get me wrong. This wasn't
right,
on a 5% down situation, but if
right,
somebody had 30 or 40% down
right.
and they had a great credit score, then the debt ratio, the maximum was much more flexible.
Mhm.
And then, of course, we had where things fell apart and the debt ratios were put back into place. We also, at one point, had, no doc loans where people
Right.
didn't, you kind of filled out and said what you thought you made, which just astounds me, honestly, because that's kind of amazing to think. I mean, but
Well, and there were also, this is interesting. I was having dinner up in Maine. It was just myself. So I was sitting at the bar and I was talking to this guy who was a financial advisor, and he was explaining to me that about in 2001, 2002, one of his first houses that he bought had a negative amortization, which I had never heard of. But like obviously, so for folks that don't know, and keep me honest here, Kathy, a negative amortization loan is one where your monthly payments are less. Like if it were to be amortized over 30 years at a fixed rate, you're supposed to have the same payments each and every month. But a negative amortization loan means that your payments don't fulfill that obligation. And probably the intent or the thought was, well, this house is going to go up in value over time.
that's
And,
exactly it. And they
you
usually
know,
had an option when you got your payment slip, you could choose,
right,
to pay interest only, which at least kept you on an even playing field. You weren't
right,
losing ground. You could pay principal and interest, or to your point, you could pay less than the interest owing, which meant, and I actually saw people in those situations, and that was not good because the
right.
housing did for a period of time, obviously go up, 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 and then we had the crash,
Yeah,
where values dropped substantially, and now they had a mortgage that was greater than what they paid for the house during the peak.
they were underwater.
And those loans fortunately are no longer, I mean, I hope they never bring those. I mean,
Right,
I'm not sure whose idea that was. Doesn't to me sound like a good idea at any
right,
point in time.
right. Yeah, yeah. It's well, and what I'm getting at too, the reason why I'm bringing all this stuff up is I think that a lot of people right now who aren't touching the industry or in the industry every day, there's certainly a perception that there's we might be primed for a crash, right? But if you look at 2008 and the factors that led to that crash, right, exactly the types of things that we're talking about now, and potentially people going to certain lenders and being able to get loans that they really have no business getting, right? I heard a story um, of somebody out in California that was, she was a cleaning lady, had a little cleaning business, nothing too fancy. She had like 8 or 9 houses, and then most of them never got rented out. And so pretty quickly, all those got foreclosed on, right? And that is actually a story that comes up a lot. There's probably examples of that all over the place. But there was a housing crash because people actually couldn't afford the houses that they were buying. And then obviously there was a recession that followed that market crash. Whereas if you look at today in 2022, to everything supporting everything you've been saying, there are some really strict guidelines in place that really, people are not taking out mortgages that are not qualified for them. Now, if somebody loses their job or experiences a hardship, that changes the story, but that's nothing a lender can know. And as long as they haven't lost a job before the close of the house. And so, a couple things we have going on, I think now, is that we have more equity in our houses than ever before, just because of the rise in value of them, right? And the pay downs, but you have extremely qualified people. Everyone's very qualified who's buying a house right now. So even though we're in this economic recession, it doesn't particularly translate or mean that there's going to be a housing crash. And in fact, a lot of ways, this is going off script for a minute, but a lot of ways, inflation is obviously really bad, but it does help maintain the value of the homes, even if people's affordability drops because the interest rates going up. So it's an interesting time. It's really interesting time.
It certainly is. And you're right. It is. I mean, it is a very different scenario today. You're very correct than it was back in 2008, 2009. It was a different time and place than where we're at now.
Right.
So yes, you are correct about that for sure.
Totally. So okay. So somebody gets, they pass the test, they pass the sniff test, they get pre-approved.
They get pre-approved and they're ready to go. Oh, one other thing. Can I stop for 1 second? I did not go into, I just would like to bring this up briefly, especially for first-time home buyers, is that things to keep in mind regarding your credit. So to keep your credit score up or bring your credit score up. And I have to say, some of these are obvious, I guess I'd say. Some of them, if I wasn't in the business, before I was in the business, I had no idea. I mean, the obvious ones are make sure you pay your bills. I mean, that's the obvious one. Don't have late payments. But any late payment, depending how recent it is going to impact your score. So the first thing is pay your bills and pay them on time, them on time. Don't let them go into collection. That's even, that's going to be even worse. So that's the first point. The second point is, while you're in this process or just prior to, don't be going out and opening new credit. They don't like to see new credit, especially multiple new credit being opened. Credit, if you need to buy a new car, obviously go buy your new car, but don't go out and open a Macy's card and open a Home Depot card, because they say, oh, if you buy, your products today, you're going to get 10% off. But you know what? The thing is, the credit bureau, you can do that once you own your house, then you're fine. But credit bureaus don't like to see that. They don't like to see lots of new credit being opened. Like I said, if you need a new car, that's one thing, but don't go opening 5 new department store credit cards. And another key thing is, which I had no idea before I did this, is keep your credit limits on your credit cards, the balances, not the limit, sorry, the balances under 50% of the limit available. That's another thing definitely that goes into credit scoring. So if you have a credit card with a limit of 4,000, even if you pay it off each month in full, which see, I disagree with this, but I don't set the standards. Um,
We
you
just
know, to
follow them,
me,
right?
if you're paying it in full, it really shouldn't matter what the limit is, but
Right.
that's just not how they look at it. So they like to see you only using 50% of whatever that limit is. So if your limit is 4,000, don't run up more than 2,000 during the month. If your limit's 10,000, 5,000. I mean, that helps substantially with your credit score.
Right.
And the other thing to keep in mind too, if we do find when we run your credit and collection on there that you may not have known about, they are changing that, by the way, because so many people have medical collections that they didn't even know about, like they just
Ah,
weren't aware of. They're changing. I can't remember exactly how they do, but I think they're not even going to account for those medical, any other type of collection, yes, but
right.
the medical ones, especially if they're under a certain amount. If it's like a $75
Right.
medical collection, I believe they're actually taking that completely out of the scoring model.
Interesting.
Which,
Yeah,
yeah,
it makes
and
sense though.
it does, because people often, don't know, somehow the bill never gets to them, and it's not like it's not like your credit card where you can go online and see you owe money.
Right. Right.
So that's a positive. But if a collection is old, if it's 2, 3, 4 years old, don't pay it off. I know it sounds ironic, but it will hurt your score more if
Huh.
you pay it off than if you leave an old one just alone.
Very interesting. That is a nugget right there. I did not know.
Yeah,
Thank you.
and a lot of people have, they think, oh, I got to go pay it off, which I would too. I would think pay it off right away. That's the best thing you could do, but you don't want to do that. You just want to let it kind of lie in the past,
Right.
and let it stay there, and it'll eventually fade away. But if it's a very recent one, then yes, you should pay it off. But
Right.
if it's
Right.
something old, then better to
4 or
leave it
5
there.
years. Right. Very, very interesting. Huh.
And yeah. The other
Wow.
two things is do not go out and also once you get approved for a loan, approved and you
Yeah.
buy your house, wait on buying your furniture until after you close. That's another thing, because, oh, here's an important point. That's the second
Yeah.
point I was going to bring up. We're going to run your credit again, not a hard pull, a soft pull, but a week before you close. So especially if your debt ratios were tight, and you go out and you rack up $10,000 worth of new furniture on your credit card bill, all of a sudden you could throw those debt ratios, and it could impact your score. It could just do a lot of things. So
Right.
while you're waiting by the furniture after you close, no matter how
Yeah.
excited you are, just wait, just
Just
wait.
hang
Um,
tight. No, that's super helpful. I've actually heard that before because so many investors in the circles I'm in are buying houses to use as a short-term rental, and it might cost 30, $40,000 to furnish a house. Like pretty quickly you can rack that up, and that can more than easily throw, depending on the type of loan that you're getting, that can really screw things up for you. It can make
yeah,
things
so
really painful.
a word of advice.
It's not easy returning that much furniture.
No. I'll
It's
take it though.
really
Well, it depends if
challenging.
I have, actually, I have no room, no more furniture in my house. Um,
Well, I'll take some for a short-term rental if you're ever getting
there you go,
rid
Dave.
of
Okay, I'll keep that in mind.
it. So let's say, buyers are fortunate to get an offer accepted on a house. What are sort of the next steps that happen from a lending perspective, and who are the players involved that take it from assuming it passes inspection and it's pretty much a smooth sailing to closing? What's sort of happening in the background, and sort of who's involved there?
Sure. So, once you have your accepted offer, then we will work on, we'll just review everything in your application that you had, filled out when you did your pre-approval. And then we will officially get you into process. Obviously, that's critical. We want to get you into process so that the next steps can happen, which I'll go over here. But at that point, you can lock. Now, here's a important point, is that when you're pre-approved, you cannot lock an interest rate in because you don't have a property yet.
Right.
But once you find a property, then as soon as you have an executed offer, not the PNS, because you'll do an offer first in the state of Massachusetts. There's always an offer, and then you'll sign your purchase and sale usually within 7 to 10 days after your offer. But
Right.
once you have that executed offer, you can lock your interest rate in. Typically, an interest rate lock is good for about 45 days on a fixed rate, although you can do a longer lock. It just, your rate is going to be better on, say, for example, a 45-day lock versus a 60 or longer lock.
Right.
ARMs do have a longer lock, an adjustable rate, a 10-1 arm, which is very popular these days because of the uptick in interest rates. That has a 90-day rate lock. So there's more flexibility on that. I mean, typically people are closing within 45 days, so that's not a problem. But if you have a closing further out, that 90 days can give you more flexibility. Obviously, you can also, like I said, do a longer rate lock with a fixed, but the typical is 45 days. So now you can lock your rate. We'll send out your application package to you. In order to go into process, you do need to sign your application because we need to know that you officially want to go into process. So you do, that's an online, you get it via online, you sign it online. And then after that is when some of the other players are going to start to come into play. So one of the first aspects after your loan goes into process is ordering an appraisal. So you're going to pay for the appraisal after your application has been signed. This is the one item you pay for upfront
Or closing.
before closing. All of the other items you're going to pay for at closing. So your other closing costs, that's another thing I should mention. You will have closing costs, which on a purchase, you do need to pay out of pocket. On a refinance, you can roll them into your loan amount, but on a purchase, you need to pay those out of pocket, along with any taxes due, tax escrow. You're going to need to
Right.
pay for 1 full year of homeowners insurance. So I always say to people, in addition to your down payment, depending on the purchase price of the home, because it's, or the property taxes, I mean, there's variables in there, but figure roughly another 7 to 10,000
Yep.
for those other items that you need to have available. I mean, these are things we go over when we have our discussion, but just those are funds you need to have. But now you've got your funds, you've got your house accepted, you're in process, the appraisal is ordered because we want to make sure that the value is there. Obviously, no lender wants to lend on a home if you're buying it for, $550,000 and the appraiser says it's only worth $450,000. That's not a situation we like to have. Hopefully that never happens. It usually does not, but we do need to.
And for people that want to know why, is because if the buyer stops paying their mortgage, the bank does need to be able to reclaim and sell that asset and not lose money, because
That is 100% correct. You want to make sure you have that there's some equity in that property, that you're right. If for some reason you stop making your payments, then that is how the bank, because obviously
works.
they're going to have a lag and many other factors in there. So, so that is that part of it. Dave, you're 100% correct. So that'll get ordered, and then what'll happen on our end is we'll put your loan into what's called the processing queue or processing line, which means it's now going to have an initial review by a processor. I mean, I do the first review, obviously, but then it will also be reviewed by a processor. And then it will also, oh, and the other factor, sorry, I forgot one other very important component. The attorney. I forgot about the attorney. And that's actually often before you, you're going to need an attorney to review your purchase and sale agreement.
Right.
You don't need the attorney during the offer, as Dave will inform you of all of this, but once you have an executed offer, you're going to want to have an attorney review your purchase and sales. I mean, this is your most important purchase, at least for 99.9% of us. And that other 0.1%, they're not looking for a mortgage. If they're buying multi-million-dollar yachts, they probably don't need financing.
Yeah. Yep,
But for the rest of us mere mortals, this is your most significant purchase of your life. I mean, it is.
right.
So you want to make sure that when you're doing that purchase and sales agreement, that it is a fairly, in some senses, standard agreement, but you still want someone, because it is prepared by the seller's attorney. So you want your buyer representation from your attorney reviewing it, just to make sure that you are protected. I mean, you will have a mortgage financing contingency date that, protects you in case for some reason your financing did not go through. And the attorney will check to make sure all of these dates are good. Any other, every transaction has some little innuendos usually to it. So sorry, I forgot about the
Oh,
attorney.
yeah, it's great. It's totally cool. Totally.
But that's going to happen earlier in the process. And then the
Yeah,
attorney is going to be part of the process, obviously, because they will also execute your closing on the day you actually purchase your
right.
home. So they are part of your whole process as well. So sorry about that, Dave.
No.
Um,
And just so to like catch people up, so essentially offer gets accepted, hopefully. There's usually some period of due diligence that happens, sometimes not. Then the purchase and sale agreement is reviewed by an attorney and then signed by both parties. Once that is signed, the buyers can actually formally fill out and sign their application. And that application kicks off the rest of the process, one of which those steps is the appraisal is done on the home. And then what else is sort of happening in the background there?
So now the next step is going to be an underwriter, who really is the person that is going to decide, yes, we are going to provide financing. So
Right.
an underwriter's job is strictly, that's all they do all day, is they review loans. They don't even like to talk to us. They live in their own little world. They do talk to us on occasion.
Yeah.
But but they are busy making sure that everything is reviewed correctly, because obviously their job is on the line if
Right.
somehow they are approving something incorrectly. So they do have a very, very important job. But they are going to, the first review, typically, just so you're aware, there's going to be almost always some additional documentation they ask for. I mean, documentation is going to be part of the entire process. So even though you submit a lot of documentation right up front with me, you're going to submit more. Some of it's just timing, because you're going to sign a purchase and sale agreement, after you put your loan's going to go into process, the P&S won't even be signed. So, so we're going to get the P&S later. We're going to need to see the cash check, to show that the funds that you put down with your P&S actually have been taken out of your bank account. So but there's other things. I swear, I do a very, very complete application, and they still come up with something. I don't know how, but
give it to them.
they just do.
They need a blood sample. Give
Yeah,
it.
if they can't come up with anything else. So just be prepared. There's a lot of documentation when you are applying for a mortgage. The faster you return, requests for any documentation, the more quickly your loan is going to be approved. One of the important dates, I think we were talking about the purchase and sale agreement, is your commitment date, because that is the date. Typically, that's a 3 to 4 week time frame after you have an executed offer P&S on your home. That date is when the bank says, or we say, I should say, that you are approved. We're going to give you financing, and everybody wants that commitment. That's a very, very important item. So once you receive that you are good, you're approved, you're going to close on your home, whether it's next week or 3 weeks from now, but we now have said that you are good to go. We may, there are things that happen after that point. Your employment does get re-verified a week before you close, just to make sure, or a few days, depending, somewhere in that time frame. We want to make sure you still have a job. That's a important part of the equation, obviously. And so far, I better knock on wood, but never in my 15 years have I ever had anyone not have their job when it came time to close. So that has never happened. I'm sure it has happened, but I have not
Right.
experienced that situation.
That is good. That is, well, and I mean, and on top of the job, and we don't have to get too far into this, it also depends a little bit, correct me if I'm wrong, the sort of format of your employment, right? Like if you're a W-2 and you've been working in that industry that you're currently in for 1 or 2 years, you're more financeable than maybe somebody that is in strictly commission or 1099 type of job, self-employed, where you just started out, right? Because there's not that longer proof of employment.
That's a good point, Dave. So you're right. I mean, if you're W-2, and we do need it, by the way, we do, no matter what type of income it is, we do need a 2-year history. But now school counts, so if you were in school, whether it was undergraduate or high school or graduate school, that would be considered a job.
Right,
And then, so, if you just recently graduated, you can still apply for a mortgage as long as you obviously are working and have a
right,
job.
right, right,
Um, and, but the other factor for, as you mentioned, so that would be for, W-2 employees. If you are, we won't go into all the depth on this, but if you're, that's for fixed income. If your
right,
income is variable, which can be somebody that works for a corporation or self-employed,
right,
because if you are fully commissioned, if you're 100% commission, that is variable income. So we will need to take a 2-year average. If you made 40,000 last year, you made 80,000 this year, your income is going to be 60,000. Is that from our perspective anyways. Now,
right,
if your income was 60,000 last year and 40,000 this year, now your income is declining. That could sometimes present a problem even being approved, depends on the reasons and how much,
right,
but we would use the lower income. We're going to use the 40,000, not the 60. We're not going to average it because the income is declining.
right,
So that's something to keep in mind. Self-employed, we want, at least 2 years of self-employment. You need 2 years. You need 2 years of tax returns, I should say. We need those 2 years of tax returns. And again, averaging the same way as, we do add back in certain factors such as depreciation, amortization, and there's different types of self-employed income. There's the Schedule C, there's a S Corp, there's a partnership, there's a variety of different, can you hear the rain? It's raining. It's raining where I am.
oh no.
Yeah, it is raining.
I'm sure it's coming here soon then.
It is raining. I didn't even think it was
I
supposed to
can't
rain
hear it
today.
on my end, but you're in the clear.
Well, that's good. I'm glad you're not hearing the rain coming down because I can hear it. But so those are sort of some of the factors that we look at when it comes to income.
Yeah, no, that's super helpful. And it is funny because in my world, when I'm wearing my investor hat, there's a lot of people that have this like rat race to you know buy houses that produce income and then quit their job because they hate their boss, and they get 3 or 4 houses and they love it, and then they quit their job and then they're like, okay, great, I want to go buy another house, and no one will let them buy a house.
Yeah, yeah.
you know where it's important because for everything that you're saying is that for any newer investors out there, or people starting out that maybe they're making a lot of money on a couple of short-term rentals, there's a logistical side here where maybe if you hate your job and you want to be an investor, you find another job that you can just deal with more for a few years until you have that income. But it's super important to be able to show that.
To show some income, you're right, because there's, yes.
Yes.
That is important.
Yeah. So, well, this is really great. I know that we're coming up towards the end of our time here. This was really awesome being able to really sort of break down and walk through what's happening from, when you're getting pre-approved to when you're closing, but also why all of these things have to happen, right? And a lot of these types of standards are put in place for a reason. They're not to make people's lives harder, but it's to protect both the borrower and the bank. It really kind of protects everybody. So with that, are there any other things you can think of that we should put out there as it has to do with loans and mortgages and all that good stuff? I think we covered quite a bit.
I think we did too. And I just realized we have been on for a while. Um, I think that the only other thing I'd probably mention is just the fact that there are, I don't think we really got into this earlier, that there are fixed rates and there are adjustable rate mortgages.
Yeah, why don't we talk about that for a minute?
And the fixed rate obviously means, whatever interest rate you lock into, that's the rate you're going to have for, the rest of your mortgage lifetime. A variable rate, a very popular product right now because of the recent uptick in interest rates, has become, I will tell you, the 10-1 ARM.
Right.
I'd say about 90% of the clients I'm working with right now are taking a 10-1 ARM. Just because historically, chances are you'll either refinance, sell, or do something. 10 years, like a 5-1 ARM, I would personally never be comfortable with because that's a very short period of time. But 10 years gives you a much, that's a long time. That's a substantial period. And historically, people do something in that 10 years. So it's a nice saving. So for example, right now, the difference between a 30-year fixed and a 10-1 ARM is a full percentage point. That can make a big difference in your monthly payment. You're looking at 3.875 on a 10-1 ARM, or you're looking at 4.75, on a fixed.
At least.
Or higher. I mean, we luckily have some in that range right now,
Right.
but that's a percentage. So it's certainly a reason that a lot of people are currently looking at an ARM as a positive alternative to a 30-year fixed. And then, like I said, if interest rates come down, you can refinance into a 30-year fixed at a lower interest rate. If that happens, you may, like I said, you may sell your home. There are a lot of things that can happen in the next 10 years.
Right.
But those are a couple of options.
Yeah, absolutely. Well, this is really great. So I'm going to wrap us up here, and then Kathy, you can stay on so we can hang out for a bit. And our guests won't get to hang out with us, but with that,
they don't need to hang out for that part.
With that, Kathy, thank you so much. Kathy, again, is a senior mortgage planner with Onto Mortgage. That's ONTO Mortgage. So Google them. Definitely look them up. Thank you so much for being on the Hassle-Free RE podcast. Again, my name is Dave Menapace. I'm a real estate agent, investor, consultant, just someone that'll talk forever about real estate because I love it. And with that, everyone, have a great day.